Morning. Top Gun here, a few minutes before 3 a.m. Pacific Standard Time on Tuesday, March 9th. This is the YouTube pre-market commentary. So March 9th, 2021, this actually marks the 12-year anniversary of the beginning of the great bull market coming out of the Great Recession, which bottomed on March 9th, 2009. A day that I well remember for an intraday reversal, and in my first few years as a professional investor. So it's been 12 long years for me, being a bear. Long time no eat. I'm hungry. Time to eat. Okay, getting to it. I led off with a nice tweet from Eddie Elfenbein showing that the NASDAQ is now down more than 10% on a closing basis from its recent highs, and is therefore in what's called correction territory. Anything greater than 10% is considered a correction. Anything greater than 20% is considered a bear market. Okay, so yesterday market was kind of chopping along the first couple hours, and then it sold off the last 4.5 hours of session, especially the NASDAQ, which sold off hard, finishing down 2.41% on the lows, whereas the S&P was only off 0.54%, and the Russell was up 0.49%. Now, the crucial thing to understand about yesterday was the disparate performance between value stocks and growth stocks. Once again, so as you can see in the chart that I've included, the IVE, the S&P Value ETF, was actually up 1.17%, while the IVW, the S&P Growth ETF, was down 2.12%. So the S&P, right, was down 0.54%. So it seems like just a middling day. But unless you understand that, whoa, value stocks had a good day, growth stocks had a really bad day, then you understand what happened yesterday. Okay, turning to the technicals. The S&P closed a few points below its 50-day moving average. We'll call it the 50-day moving average, so it seems to be finding support there, as it's a more value-laden index than the NASDAQ, and is therefore holding up the best with this rotation out of tech and into value stocks. If we look at the NASDAQ, we're we're in correction territory, and we've closed significantly below that 50-day moving average for a number of days now. The same thing can be said about the QQQ, the most important ETF in the bull market. The SMH has now quickly gotten significantly below its 50-day moving average. That's the semiconductor ETF, and ARK is so far beneath its 50-day moving average that it nearly touched its 200-day moving average, calling into question its bull market status on Friday. Now, I called for a powerful rally towards the end of last week, and yesterday I did put my money where my mouth is and put a 10% trading position on for myself and clients in ARK. A lot of you will be surprised by that trade, considering my disdain for Cathie Wood and the ARK Innovation ETF, which I am extremely long-term bearish on, and I intend to short shortly. Excuse the pun. But for now, I think it's a great way to play the balance, as it has the most beta. And it looks like we're getting that today, with the S&P futures up 1%, NASDAQ futures up more than 2%. I just checked maybe 15 minutes ago. 15 minutes ago. Okay, finally, let's just talk quickly about Stitch Fix earnings. Stitch Fix is not necessarily that important of a company. They have a subscription fashion service where they'll send you clothes, I believe, and you get to choose if you want to keep certain items, and you send back the rest. And it's custom designed to your personal style tastes. Perhaps their algorithms evolved a la Netflix. Anyways, it had been a really hot stock, hitting $106 a share to the close on January 27th. But in the pre-market, it's trading at around 53. Last time I checked a couple hours ago. So down 50% from the highs, down 23% in the pre-market today, off of a mediocre earnings report, with revenues up 11.6% and 20 cent per share diluted EPS loss. So just another example of how growth stocks are being taken to the woodshed. See you guys tomorrow. Have a great day.